What a great job. Really good job, man. Sharing with people the problem. Now we're going to get into some of the solutions and how we have to look at this. And Justin, can you see my screen? Hold on just a second.
I see you.
Okay. You see the
Monopoly board?
The Monopoly board? That looks familiar, right?
Yeah.
Now, I'm not bragging, but I've never lost a game of Monopoly in my life. And there's one reason, Justin, is I'm playing to win. Now, my family, they're sweet. They're playing to have fun.
Was you hadn't played music. That's what I thought.
Well, and if you know how to play, then I guess we'll see what happens, right? But when most people play Monopoly, they look at who's got all the money on the side of the board, right? And they focus on that and they say, wow, look at that. Nick Costco's got a lot of money on the side of the board. He must be winning. But that's not how you win Monopoly. And there's only one rule of Monopoly that matters, and it's four houses equal a hotel, right? Because if I have this corner of the board or this side of the board or this side of the board, it doesn't matter if I have hotels there. I'm going to take everybody else's properties, bankrupt them, and I'm going to win. Because they're playing to have fun, I'm playing to win. Yeah. You ever feel like, Justin, that there are people out there in the world that are playing the game of money for real? They're playing to win, and everybody else is kind of playing to have fun. And they're part of the herd. They haven't broken away from the herd, right? And so that's what we want to talk about is we don't want to be in the herd because nothing good happens if you're in the herd, right? You have to break away, but you need confidence to do that. You need coaching, and that's what Nowlin Financial or Nowlin Wealth Management and Create Tailwind, that's what we're here to help with. But you have to think to do this. This isn't just something where you give your money to an advisor and then you hope that advisor earns you money over time. It just doesn't make sense. But, Thomas Edison pointed out that only 5% of the people think, 10% think they think, and the other 85% would rather die than think. That seems crazy to me. Okay, so let's kind of talk about what we do in this infinite banking system, okay? Is we have this insurance policy, and the policy has cash value. And like Justin said, this is designed for cash value, just like banks have bank-owned life insurance, corporate-owned life insurance, etc. It's designed for cash, not death benefit. Now, Justin, I know you're like me. I have more death benefit than I would ever have just bought for death benefit. And I kid around with my wife and I tell her, honey, if you get the check before the funeral, try to look sad at the funeral, okay? But because I have a lot of death benefit, right? And is my son on here? I don't know if I want him to know exactly how much it is. No, I'm just kidding.
I'm listening.
Yeah, he's listening now. See, now he's paying attention. All right, so you have this cash value in this life insurance contract, right? Again, like you said, a specially designed insurance contract with a mutual insurance company. Why a mutual insurance company? Because we own part of the company. We get to share in the profits. It's an actuarial-based company. It's not a market-based company. Actuarial science is behind this company, right? Doesn't that make you feel better, Justin, about where your money is?
No question. There's just a level of safety there.
Absolutely. And our money grows, like Justin said. This blue line represents uninterrupted compounding every single day, no matter what. And again, because we own this insurance company or part of it, we're allowed to borrow from the insurance company, their money, interest only, right? Interest only, and this is something that 95% of licensed insurance people don't know, Justin, is that when I take that loan, my money doesn't go anywhere. They put a lien on my cash value, right? And they got to give me their money. Now, remember, my money's in a tax shelter growing tax-free. And potentially I'm going to get the money out tax-free, and they got to give me some of their money. So, we have a CPA on the line tonight, and I don't give tax advice, but if I'm using that money for a business expense or I'm using it for a reason that I would be able to deduct if I borrowed the money from the bank, then I'll let your CPA tell you whether you can deduct that or not, okay? But my CPA allows me in a lot of cases, Justin, to deduct that. Now, how many things in your life, Justin, does the money that you're paying, you can deduct from your taxes, and the money you're earning, you earn tax-free? Not very many.
Not many.
Okay, so now we're going to talk about you, because remember, I said you got to play this game of money better than other people are playing a different game. So now we're talking about your behavior. Now, I'm going to talk about specifically buying assets. And again, the CPAs right now, when I draw this ledger out like this and I put assets on the wrong side, they want to pull their hair out unless they got their head shaved like me. But I'm going to show you, CPAs, that we're turning liabilities into assets. So we could put in here, we're going to buy our cars, right? And the interest that we would have paid to buy our cars, or the lost opportunity cost that we would incur by paying cash, we're going to recapture and pay back to us, okay? But what I want to talk about is how do we use the insurance company's money to go build our wealth? So let's say we're going to buy some real estate. I buy some real estate. I buy real estate for two reasons. Either it's going to appreciate in value or it's going to cash flow, or hopefully both, right? So the cash flow, when it earns money, Justin, I'm going to flow that money back through my banking system. Now, I don't have to pay the insurance company any principal. It's an interest-only loan, which means it's unstructured. Now, let me just stop the example for just a second, Justin, and explain what I mean by that. Is let's say that I would loan you $100 million today, and your only obligation to me is that you got to pay me $5 million of interest in 1 year from today.
Mm-hmm.
Would you take that loan?
Every time. Every
time, because you know what to do with the money, right? Because, by the way, you have to think to know what to do with the money. So play along for a second. Let's say that you made me that same offer. I'm going to take your $100 million. I may go to the bank and leverage their money, and so I'm going to borrow $400,000 from them using my $100,000, right, as 80% loan to value, and I'm going to buy $500 million worth of real estate. And let's just say I can net 5% over the next year. So I'm going to make $25 million. I pay you your 5, and I keep 20. And you say, hey, you want to pay any principal? I said, no, not really. And I said, see you in a year, right? See you in a year, because I'm going to just pay you your 5 every time, because I get to keep the profit, because I'm the owner and I'm in control of this banking function. Okay, so back to my example. If I do pay $1 of principal back, Justin, all they do is they reduce my lien, which increases my net cash value. And guess what I do? I go do it again, and I buy more real estate, and it cash flows, and I buy a business, and it cash flows, and I run all of this cash, and it's great when I don't need this money to pay for my groceries. I just run that money back through and my cash value grows. This policy gets full. I buy another one and another one and another one, because I want as big of a bank as I can get. Okay. Now, there's two sides of this equation. Here's the policy, which is my money pool, right? And on this side is my behavior. Now, Justin, if you had to choose, which one would you take? Well, before you answer that, guess what? You don't have to choose. It's an and asset. Because I'm collateralizing this, my money never leaves. I keep all of the benefits of the policy. And I get all of the benefits of buying these assets. Now, business owners don't really own a lot of financial instruments. They own assets. They want to buy assets that are going to make them money. And if you talk to most business owners, they say, well, why would I want to put my money in that? Because I could put my money in my business and make more money. Because they invest in what? What they know. What's one of the tenets in The Richest Man in Babylon? Invest in what you know. Pay yourself first. Okay, so in the book Profit First, what he did is he took The Richest Man in Babylon, Pay Yourself First, and said businesses should do that. Take out the profit first, right? And that's why he's getting almost a cult following is because it makes sense. Okay. I keep talking about a business. Justin, I run my family like a business, our finances, right? So Nelson said we got to be in two businesses, the business that you're in to make money and the banking business. Regardless, if you're a doctor and you work for a hospital, you still are in the banking business, or you should be. So we're just going to call this XYZ company because, I'm very creative. So we're just going to start with something vanilla. And every business has kind of a start of the year and an end of the year, just like your family does, right? Typically, we start in January and we end in December. Now, nothing ever ends. It's just that's the year. The year ends like that, right? What's the goal? The number one goal is profit, but we got to pay Uncle Sam, which you did a great job explaining how we should be afraid of this three-letter word, because what we really want is residual. But here's part of the problem. Now, this happens in our families, and this happens in our businesses. Our revenue or accounts receivable or sales, whatever it is, doesn't come in level all year long. It comes in seasonally in most cases. In fact, sometimes 65% or more of our income can come in 1 or 2 months. Well, that creates a problem because our payroll, our rent, now you could, if this was a family, you put mortgage, groceries, vacations, whatever it is, expenses, they come in more level, right, throughout the year. So one of the things that happens in a business is we give people some credit to pay us. 30 days, right? We're okay. 30 days, everybody pays within 30 days. But if they got to 90 days, that creates a problem for us because we also have accounts payable to maybe our suppliers. Again, the number one thing Nelson said at the very beginning of the book, I think it's page 14, Justin, is he said, imagination. So when I'm saying this and you say, well, I don't run a business, use your imagination, how this fits to you and your family. Okay. Now, maybe they gave us some credit for the merchandise that we got from our suppliers, right? But regardless, most companies, because of cash flow management reasons, they use a commercial bank. And we normally have loans in that commercial bank and or lines of credit. So a loan is something that's amortized. It could be equipment, those kinds of things. A line of credit is a dollar amount that you're allowed to tap into. Justin, if the company struggles, what does the bank do with that line of credit? They convert it to a loan or
call it.
Or they call it. That's right. Okay, so who's in control of all of this? The bank is in control. And by the way, because they give us these lines of credit and these notes that have terms, they also expect us to put all of our sales and revenues and accounts receivable in their bank, which they then take our money and loan it to us and other people, right? And they're secure. They're going to ask for collateral, land, property, inventory, labor, which is you, right? A personal guarantee, capital, equipment, any of those things. Now, they are 100% secure. The supplier down here, they are not. They're going to get pennies on the dollar in a bankruptcy. Now, Justin, for a business and a family, all we're doing is looking for an alternative bank. And we offer, this is what Infinite Banking does, is it's just an alternative bank that has tax benefit, flexible loan terms, pays interest and dividends, has guarantees to grow. And guess what? This bank isn't in control anymore. Now you are, Justin. Is there any reason why you wouldn't want to have a bank with that alternative bank? The only answer I ever get, Justin, is, well, that bank is an FDIC insured. Okay, so let's look at that for 15 seconds. This is the reserve for the FDIC, $88 billion. The problem with that is the U.S. total bank deposits, Justin, are $7.1 trillion. Are you insured? I don't think so. Okay. Any questions on that, Justin, or anything to add? I'm gonna share a different screen here, because I'm gonna go through something else that that you both of us are gonna talk about a little bit.
Awesome. Well, while you pull that up, I just wanted to reiterate one point that has really meant a lot to me and in the real estate and the businesses that I've invested in. And so I want you guys to consider one thing that Jim talked about. This is an and asset, where in most situations for me, it's, do I buy a car or fund this policy? Do I buy a piece of real estate or fund this policy? Where here you have the opportunity to do both. You can have your money growing uninterrupted on the left side of the column, but create another asset. So if your goal is to buy 4 rental houses in the next year, you've got 5 assets working for you, the policy and the 4 rental houses. But the second piece, and Jim's about to walk through it, that I think is so critical, is we have showed you how to lower your risk. Because if you use your alternative banking system, then the loan you have total control of versus using the bank, right? So it gives you a level of risk with every dollar you're utilizing in that investment or in that purchase that you're making. So remember, not only are we enhancing your assets, we're lowering your risk. And that's what you always want to look for, right? How can I grow my wealth and lower my risk while I do it? That's what infinite banking does.
That's right. And, Justin, modern portfolio theory won a Nobel Prize in economics for saying you could lower your risk and increase your return, right?
Yep.
And this is that on steroids, really, because there's no guarantees there. It's all percentages and all Monte Carlo simulations. This is there's a lot of guarantees. And some of the companies we use, Justin, we've seen 95% of the performance guaranteed after 10 years or more. It's crazy. Okay. So remember I said you got to use imagination. And for everybody that's read the book, you come across this example called equipment financing example. Now, you got to be able to use your imagination to what this means for you. Okay. Because I'm going to tell you what it meant for Terry Nash, Nelson's nephew, that this is his actual illustration that Nelson went through with him. Now, Terry was a 30-year-old male, right? And he was preferred. He was a preferred non-smoker. And this example shows 60% of the premium going into a paid-up additions rider. Okay, and here's a really brief example of that. Is you put in $1 and you have about $1. And if I put in $1, Justin, and I could take out $1, what's my cost?
No cost. There
is no cost. Now, Justin, if I'm sitting in the audience and I never heard of this thing, and I got a friend who's an insurance agent, or I got somebody that handles my autos and my cars, why have they never told me about this paid up additions rider? I mean, Justin, if I put in $1 and I could take out $1, how much do you think they paid that insurance agent? Not much, right?
Right.
Okay. Now, this is the base premium, $15,000. I like to round to, Justin. So that's 40%. Okay. So that's how our breakdown is on this policy. Now, this guy's 30 years old. Okay. I'm 54 years old, Justin. About a month from now, I'm going to be 55. And I've bought, I think, 4 policies since November. Okay. So I'm going to show you why you don't have to be 30 to do this. But this guy happened to be 30. And he only put 40 grand a year in. Okay. Now we have people that are putting millions of dollars a year in their banking system because it's their banking system. Right. But this is 1984. Okay. And in 1984, you could put money in this insurance contract for 4 years, and then you didn't have to pay any other dollars out of pocket if you didn't want to. Okay. This is the net annual outlay. All right. Makes sense. Now today, that's probably 6 to 8 years before that would happen. Again, this is no banking. This is not infinite banking. This is just a life insurance contract. Okay.
Yep.
Now, the problem with putting 0 in here, Justin, is the premiums for this $15,000 have to be paid every year that the policy's in force. Okay. Or until the policy doesn't allow premiums anymore, which happens today. Right. But nobody said that you had to pay it out of your pocket. I could pay it from dividends, but I'm about $9,000 short. So what do I do? Well, what they did is they used part of the death benefit, and see, the death benefit goes down because they're surrendering part of the death benefit, right? The paid up additions till they get to year 17. Year 17, the dividend is higher than the premium, so it'll pay 100% of the premium, and their death benefit starts to go back up. Now, in this example, Justin, they don't do anything. There's never a loan on this policy for 35 years, and it grows to $1.5 million, okay, in 1984 dividend scale. All right. Now, this isn't how it's done in the book, but Nelson would tell you that you would withdraw the basis, and then you would borrow the money out so that this $92,000 would be tax-free. There's an addendum in the book that talks about this is not how Nelson would have done it. He's trying to explain something and making something that sometimes seems complicated, which it's not, but he's trying to make it super simple. And the reason he chose $92,000, Justin, is he wanted the death benefit to stay the same and not go down. He didn't want that to be like a negative. Well, yeah, you're doing that, but the death benefit went down, right?
Mm-hmm.
Okay. All of that makes sense? Anything to add there, Justin?
No, Jim, you did a great job explaining it. Again, think of it, this is your safe money. This is just a bond alternative. And look at, we could get technical, but that would probably be around an 8.5% gross rate of return, and you've got the majority of it guaranteed.
Is that crazy?
Yeah.
Okay. Now, remember I said Terry, he's in the logging business. Okay. And just for sake of time, I'm going to go through this a little bit quicker, but he's got 4 trucks, 2 tractors, a tree shear. He's paying $16,000 a month for his equipment. And guess who decides if he gets that money or not? The finance company, the gatekeeper. They're in control. Whoever's in control of the money makes the money. That's an adage that holds true every time. Okay, so let's take one of his trucks. We're only going to go through one example of this, Justin. Okay. In 1984, Peter built $65,000 for that car. Now, I've been told that some F-150s are over $100,000 now. So I'm going to hope that you could buy a $65,000 F-150 and it'd be a really nice truck, okay? I don't want to be disappointed and feel that old that you can't, okay? So just, again, use your imagination. If you like to buy really, really nice cars, then put your number in there. But this is $65K for the car, $13,000 down. He's going to finance $52,600. Okay? Now, this is commercial paper, so it doesn't tell us the interest rate, but we know that it's a little bit over 11%. $52,600. He's going to pay back $72,000. That's 48 payments of $1,500, right? And they call it time price differential finance charge. Okay, and I'm rounding here, obviously, but $1,500 a month. All of that makes sense? Okay, so Justin, the only thing that he does differently in this example, the only thing is right here, he borrows out $52,600. Now, so why does it say $34,600 there? It's because this is the net annual outlay. He's paying $1,500 a month, which is $18,000 a year. 52.6 minus 18 is 34.6. Does that make sense? Absolutely.
Yep.
All he does, Justin, is every 4 years, he just takes a loan. Look at all this money over here that he's not using. He's only taking a loan every 4 years just for one truck. And by the way, he only put $40,000 in there in the beginning. Mm-hmm. Now, this is a guy that's paying $16,000 a month for his equipment. All right, so it's all in scale, right? So look what happened to his cash value. He's got $470,000 more cash value, more wealth for him. Justin, did he take any more risk?
No.
Did he change his cash flow $1?
Not a cent.
Did he work any harder?
Nope.
He thought, though. He had to think to do this, right?
Yeah.
Look what happened to his income. It's $125,000 now. His death benefit went up. Hey, by the way, Nelson has him dying at 85. I can't fix that. But now with medical breakthroughs from 1984, maybe we should make that 95, right? Yeah. I wish, by the way, Nelson was here to write that book again or to revise it. Okay, so $470,000. Whose $470,000 was it going to be? Who was going to collect that money if he didn't?
The finance company.
The finance company, the banks.
Yep. Why
is the bank, like you said, the nicest building in town? Well, that's a lot of money on one truck over and over and over again for a lifetime.
Hey, Jim, I want everybody to really circle that one more time. Guys, I want you to really think about this. The only thing that was different is this guy took action to be an owner versus a customer. He changed his thinking. He did something different than what the others were. And now he's earning on both sides of the equation. So the profit that would accrue to the bank owners and the bank shareholders are now accruing to him on the same dollars he was spending anyway. So you said it great. Without changing his cash flow, without taking any additional risk, without paying any additional taxes, just by thinking like an owner, he added an extra, ballpark close to $500,000 plus the death benefit that he leaves for his children and his grandchildren, which Nelson used to say was just thrown in on the side as an added benefit.
Absolutely. And so think about this for a second. Compared to what? He could have put money in the stock market and tried to build $470,000. So where would he have gotten the money? Because here we didn't change his cash flow. So he would have said, hey, instead of expanding your business, instead of growing your business, take some of that money and put it over here, right? But he didn't have to make that choice, Justin, because he just redirected money that he was already paying. Now, whoever invited you to this meeting, have them go through the rest of this example, but I want to show you something because there's got to be somebody in the audience, Justin, that's saying, well, I'm not 30 years old, blah, 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 right? And again, I'm not either. Now, by the way, when he maximizes, and he doesn't really maximize, when he buys more trucks, in the book, Nelson shows you how he generates $2 million more net worth, cash value, right? And he does $225,000 potentially tax-free income. And he didn't put any more money in the thing to build the 2 million, Justin. He just ran more of his business through it. But I want to show you guys something. This is my reason for jumping to this page. And we have a great video on YouTube that goes through this in a little bit more detail. It goes through all of the different, how he builds it up to this. But if you said, hey, yeah, that's great for a 30-year-old Jim, Justin, but man, I'm not 30. And okay, so remember, he only put 40 grand a year in there, right? He could have started banking, Justin, in the second year. He had enough cash value to borrow the $52,600 out for that truck in the second year. Look at all this money that's sitting over there. He could have bought more. He could have financed more, but Nelson had to make this simple to understand. I mean, can you imagine what this thing would look like if he really maximized it? You'd never be able to understand this. Yeah. But the person that invited you to this meeting, they can walk you through this to where you could use your imagination and forget about equipment. And what are you going to finance? Are you going to finance real estate? Are you going to finance franchises, other businesses? Sky's the limit. You get to think. Doing infinite banking like this is a peaceful way of life. Nelson always taught us because what's the alternative? Hope that your money's growing when you're not in control of it. This you're in control of. How many business owners out there need to do this? How many of us need to act like business owners in our personal lives? Justin has used this to build businesses, real estate. I've used it to build businesses, real estate, other people on this call that we both coach and our firms coach and people that work at our firms. The reason that we're doing this with these firms is we walk the walk. We haven't been doing this 3 years and, you know, and here's a great concept and idea, and we're really good at building click funnels. We'll show you what we've done with this. We'll open it up to our system. Anything to add to that, Justin?
No, Jim, what's amazing to me, I've been practicing this 12 years and I continue to get excited every time I see it because there's more I can do. And I know that. And so if you're out there, like Jim said, if you got questions, ask them. You know, the only thing different, and you've already showed that you're part of the, you know, there's the old 80-20 adage. You're part of the 20% because you took time on a Thursday evening to take an hour and spend and get on this call. So what's the next step? Get with the person that invited you, ask your questions, get Nelson's book, think about some examples, let them help you, and you can begin to implement this. And I keep going back to it because Nelson pounded it in my head. Think like an owner. Think for yourself. Think like an owner. And you have the opportunity to do that. Great job, Jim.
Yeah, I thank you, Justin, and thank everybody for coming on. And Justin, thank you for doing a great job setting up the problem. And really, this is the solution. It needs to be part of the solution for you, and it should be a significant part for you.
Hey, Jim, I did want to add one more thing.
Yeah.
You know, we're in a pandemic. There's a lot of people would call it a crisis. There's a lot of thoughts going on. Candidly, there's a lot of fear. I get calls quite often that are concerned. What's going to happen in the economy? What's going to happen with money? What's going to happen in the market? And the one thing that I will tell you, Nelson always said, is where there is money, opportunity will find it. And here's what I want you to know. There is going to be opportunity coming out of this crisis that we're in. We're already beginning to see opportunities, businesses, franchises, real estate. There are going to be people that you can impact with this idea. There are going to be opportunities for you to make purchases for your family and understand how to use the and asset versus an or. Understand how to have your money working for you, how to create more assets is an opportunity that I don't think you're going to want to pass up. We haven't seen anything like this in 11 years. And we may not see anything like it for a long, long time. So be prepared. And the only way to be prepared is just take action.
You know what? There's only one thing that cures fear, right, Justin? What's that? Action. Action cures fear. You know, I mean, if you're afraid of something or you're fearful, take action. And, you know, this is, I'm so thankful and grateful that I have Infinite Banking working in my life and that we get to share this with people. Because I got to tell you, I know that now in Wealth Management and Create Tailwind, we've been busy. We are slammed with appointments. Not, by the way, we'll get you in. We're just working hard and working long days because we want to share this with people because this eliminates fear of the unknown. It eliminates fear of you losing control of your finances, your wealth, everything else. This takes back control, takes back your finances. We're here to coach you. It's all free. We don't charge you a fee to do any of this. So get a hold of the person that invited you. Justin, any famous last words?
No, man, it was great. Enjoyed being with you.
Yeah, thank you all. Appreciate you. Grateful for you. Have a great night and stay safe.
See you, everybody.